Assalamualaikum and hi. Today we would like to present about the technical analysis. Technical analysis is a method of determining the future prices of the stock using chart to identify the pattern and trend, such as price movement and volume. One of the indicators in technical analysis is moving average convergent divergent MACD. MACD is a trend following momentum indicator that show the relationship between two moving average of a security prices. The formula of MACD is 12-period EMA minus 26-period EMA, and the result of that calculation is the MACD line. A 9-day EMA of the MACD, called the signal line, is then plotted on top of the MACD line, which can function as a trigger for buy and sell signal. Trader may buy the security when MACD cross the above its signal line, and sell the security when MACD cross below the signal line. MACD indicator can be interpreted in several ways, but the more common method are crossover, divergences, and rapid rises or fall. What is EMA? EMA is a type of moving average that places a greater weight and significance on the most recent data point, also referred as the exponentially weighted moving average. It reacts more significantly to recent price changes than a simple moving average, which applied an equal weight to all observations in the period. The MACD have a positive value whenever the 12th period is above the 26th period and a negative value when below it. The more distant the MACD is above or below its baseline indicates that the distance between the two EMA is growing. In the following chart, you can see how the two EMAs applied to the price chart correspond to the MACD. Blue color crossing above or below its baseline, red dash in the indicator below the price chart. MACD is often displayed with a histogram which graphs the distance between the MACD and its signal line. If the MACD is above the signal line, the histogram will be above the MACD baseline, and if below, it will be below the MACD baseline. Traders use MACD histogram to identify when bullish or bearish momentum is high.
Hi, my name is Saadah Binti Ahmad. Next, I will proceed with random walk theory. The random walk theory or the random walk hypothesis is a mathematical model of the stock market. Random walk theory suggests that changes in stock price have the same distribution and are independent of each other. Random walk theory infers that the past movement or trend of a stock price or market cannot be used to predict its future movement. Random walk theory believes it is impossible to outperform the market without assuming additional risk. Other than that, random walk theory also considers technical analysis undependable because it results in parties only buying or selling a security after a move has occurred. Next, random walk theory considers fundamental analysis undependable due to the often poor quality of information collected and its ability to be misinterpreted. And lastly, it claims that investment advisors add little or no value to an investor portfolio. Next, how can random walk theory be applied to investing? Random walk theory maintains that the movement of stocks are utterly unpredictable, lacking any pattern that can be exploited by an investor. This is in direct opposition to technical analysis, which seeks to identify patterns in price and volume in order to buy and sell stock at the right time. The professor at Princeton University and writer of A Random Walk Down Wall Street performed a test where his students were given a hypothetical stock that was initially worth $50. The closing stock price for each day was determined by a coin flip. If the result was head, the price will close a half point higher, but if the result was tail, it will close a half point lower. Next, this chart shows a random walk hypothesis test by increasing or decreasing the value of fictitious stock based on the odd or even value of the decimal of PI. The chart resembles a stock chart. Lastly, the implications of random walk theory is impossible to predict the movement of stock price. The second one is impossible for a stock market investor to outperform the market in the long run. And the last one is the failure of money managers to consistently outperform the overall market has led to the questions of an ever-increasing number of passive index funds.
Hi, my name is Binti and Azmin. I would like to present about the RSI. There are many technical analysis tools out there, and one that is increasingly popular is the RSI. RSI stands for Relative Strength Index. RSI measures the magnitude of recent price changes to evaluate overbought or oversold condition in the price of the stock or other asset. RSI is very often used as an overbought or oversold indicator. These help the trader calculate the next move as they would be able to predict where momentum is headed. Next, the meaning of overbought and oversold. Overbought describes a period of time where there has been a significant and consistent upward move in price over a period of time without much pullback. Oversold describes a period of time where there has been a significant and consistent downward move in price over a period of time without much pullback. Next, example of RSI divergence. A bullish divergence occurs when the RSI creates an oversold reading followed by a higher low that matches correspondingly lower low in the price. A bearish divergence occurs when the RSI creates an overbought reading followed by a lower high that matches corresponding higher high on the price. RSI formula breakdown. RSI is equal to 100 minus 100 divided by 1 plus RS. As you can see over here, RS is equal to average gain divided by average loss. The higher your average gain, the higher your RSI gonna be. Next, the bottom line is, first RSI goes up, average gain greater than average losses. While for RSI goes down, average gain smaller than average losses. The best market for the RSI indicator is the stock market. First, the stock market is long-term trend. For example, economy growth, GDP increases, and the country does well. Next, the pullback in the stock market are usually short-lived. We can actually use the RSI indicator to be looking for buying opportunities.